Good morning, everybody. Mike Vacchi here for Princeton Trader with your Friday morning pre-market webcast. Okay, daily chart of the ES. It's played out as we basically expected. We had some follow through from the bears yesterday. They did make a lower low. The bulls now are trying to rally it back, and we're getting a critical test right now of the 1508, 1509 middle Bollinger Band, which makes sense. You know, we punch the upper band, we pull back to the middle band, we've broken through, and now this key area needs to be retested. As I mentioned yesterday, the critical thing you have to watch out for if you're a bear is losing the 1517 level. I think losing the 1517 level sets itself up where you could go ahead and have enough new buying come in at that point. Because I think if it goes much farther, you're going to continue to see some shorts cover and kind of get squeezed out of the market a little bit. And then, the new buying would come in over 17 and probably take us up to, either a double top or new highs. So the bears, like I've always said, they cannot take any days off. The ball is, on a trend basis is squarely, in the bulls' court. And the bears are going to have to do a lot of work to reverse that. The dip buyers are not going to go away. They may get knocked down for a couple of days, but they're going to come back. And they're coming back right now, right off that 95. They're up 13 handles off yesterday's lows, and they're going to push things. Because why wouldn't they push things? Look at this chart. Why wouldn't a dip buyer push it? Of course it's going to push it. Because every time we've gone and done new highs. So the bears are going to have to come in and defend some of these levels, starting with 1508 to 1509. So that's that's what I'm really looking at. I don't normally talk about gold, but let's talk about gold real quick because I put a chart out a couple days ago talking about mean reversion trade in gold. It was out on Twitter and was up on our website. We touched the third standard deviation in gold. We did a higher low relative to the third standard deviation Bollinger Band. Even though it was a lower low in price, it flashed down to 54s in the middle of the night there. And I talked about how, with gold, it tends to, when it hits that third standard deviation Bollinger Band, the third standard deviation Bollinger Band means you close your eyes and you buy. And it may go lower from there, but it won't stay lower because statistically, it's going to come back at least into the Bollinger Bands because even if it wants to go down, this is a whole riding of the Bollinger Bands down, but you at least have to be at the Bollinger Band to ride it. So it's completely out of the lane. So, and what did we see? Gradually overnight, it came back up to deal with this fib level here, 1584.80. And it's failed from there, and it's going back down to test the band. So just, 30, 45 seconds out of this, usual thing that's just ES to talk about mean reversion. This is a classic mean reversion trade, and this is what gold tends to do when it gets overdone. It doesn't mean gold's going to go back up and hit highs, but you're a trader, okay? You're not some gold pundit on CNBC, or maybe you are. Even if you are, you should trade gold, and if you do, when it gets overdone like this, you should fade it the other way and grab 10 or 15 or $20 and then let it go and move on with your day, because trades like that in gold, they come along every few months and they tend to do very well. So they're pushing ES down a little bit here, so we'll have to see what happens. The only other thing I'll mention before I go is the 3-day and 9-day pivots are locked up at, wait for it, 1509, and you can get those pivots on the homepage, Princeton Trader. You can get them at MrTopstep.com or on our Twitter feed at Princeton Trader. So everybody have an amazing weekend. Mike Vacchi for PrincetonTrader.com. I will be back Monday morning with another webcast. Trade them well, everybody.